So good evening, everybody, and thank you for joining our Australian Migration Tax Planning webinar. My name is Jules Kelly. I'm the Sales and Marketing Manager for SMATS Group, and I'd like to welcome our presenter tonight, Steve Douglas, who is the SMATS Group Executive Chairman.
Hi, Julie.
Hello. Before we kick off, please feel free, if you've got any questions tonight, to submit them either in the chat room or the Q&A room, or alternatively, you can email me directly. We'll answer them towards the end of the webinar. So Steve, take it away.
Okay, let me just share screens. Extend my welcome on top of Julie's to everyone that's joining us. We've got a lot to discuss tonight. The topic is Australian migration tax planning, and of course, the Australian tax system is extremely complicated and has many layers. So it is considered very fearful to many people considering looking at Australia, and one of the reasons that people actually don't move to Australia is because they're worried about the tax. In truth, you don't need to be afraid about the Australian tax system, but you certainly need to be aware of it. So hopefully tonight we're going to cover as much as we can in this session to give you a good base understanding, and then of course we're there to support you and help you with your advice on your personal circumstances. Moving in now, if I obviously have to start with a disclaimer. Given the complexity of the Australian tax system, it would be relevant for you to obviously seek private advice in regards to your situation. There's so many little layers that could go wrong, but we're there to help you. So if you need any assistance personally, please come and see us. Check your circumstances before relying on the content of the seminar. We'll start off with obviously the issues on relocation. So obviously Australia has many issues that you have to consider, and particularly when you come from friendly tax countries, places like Hong Kong, Middle East, etc., where the personal tax rates are low, the complexity is very low. That's certainly going to be a big culture change. It's probably a bigger culture change than anything else is how you look at the Australian tax system once you relocate. The first thing I want to start with is obviously when taxation starts. And the important thing is just when you permanently relocate to Australia. A lot of people are misconceived that it's on the issue of the visa. It's not that. It's purely on the time you move yourself, your family, your belongings, and begin your life in Australia. If you do get a permanent residency visa, you do have to obviously enter Australia to get that activated. That does not trigger taxation in any way, shape or form. It's only once you've relocated yourself to live in Australia permanently. Once you do that, then you start to capture into the Australian tax system, and bear in mind you're taxed based on your entire worldwide gains on capital gains and income on all assets, business assets, income assets, salary, interest, everything is taxed in Australia. There is literally few exemptions from tax. So you just have to bear in mind that you're walking into a taxable environment. If you move funds from your old country to Australia, that will not be subject to tax unless there is an income component on that. You're not obliged to take money to Australia. You could leave money offshore, that's not an issue. But if it earns any interest, you would have to declare that interest in Australia if you were a tax resident. In the same way, if it's more than 250,000 Australian dollars, you may be liable for tax on the currency gains, or a deduction, in fact, on currency losses. But the shifting of the original capital is not subject to tax whatsoever. If you've got any international companies or trusts, they're all going to become visible and under the Australian tax system. Now, you cannot hide these things anymore. You might notice that there's more and more compliance going on at bank level, at investment level, to ask for your tax ID numbers. That's only going to get higher and higher into the future. So don't think that you can keep things offshore and it won't be discovered. The good news is any past profits you've made, any income profits, any capital gains, they will not be subject to tax in Australia. Only profits forward from the day of relocation would be subject to tax in Australia. Now that's a lot better than, for example, somewhere like America, that if you move to America, they will tax you right back to your original ownership cost if you sell an asset while living in America. That's not how Australia does it. We only tax on profits from time of becoming Australian resident. If you've got pensions overseas, you need to roll those over generally within 6 months. But in recent times, it's become a bit more complicated as the tax office has tried to look at some funds not being classed as superannuation or retirement assets if they were able to be cashed in prior to retirement age. This is extended to be Singapore MPF, Singapore CPF, Hong Kong's MPF, I should say, Singapore CPF, some employer funds. If you've got the opportunity to cash out prior to retirement age of 60, you may find the tax office isn't agreeing that that is indeed a pension. So we need to talk about that, and assess your personal situation. Any overseas property you may own or assets that you intend to retain need to get a valuation. The reason being, as I mentioned, only future profits are subject to tax. So regardless of what you paid for the asset, you need to get a sworn valuer, and he needs to be a qualified valuer in the relevant area, and get that valued as at the day of relocation. Only future profits would be subject to tax. Indeed, if you sold the property later at less than that valuation price, that may indeed be a tax loss in Australia. So you really want to get a good valuation, get your head around that if you decide to retain assets. If you've had any Australian property, that would stay taxable, but Australian shares and overseas shares aren't taxable if you are non-resident. They haven't been taxable because they're excluded for non-residents. But once you move to Australia, you're now worldwide taxed, and that includes Australian shares and overseas shares. Now, there's no need to get a valuation on those because obviously it's easy to find the price on the relative index wherever that may be. And only future profits would be subject to tax. Now, where that's important is a time like recently when we had a stock market dip due to COVID. We obviously wouldn't have wanted to go back to Australia on the day when the market had fallen. It would be nice to have gone when the market was higher. So you might delay your arrival just to let the stocks rise if you could, if that was possible. And of course, it's essential to plan in Australia, particularly in Middle Eastern and Asian countries where tax is such a low cost impact. Many people just do things without thought or advice. You cannot afford to do that in Australia. It is essential to plan because we do have high tax rates and everything is subject to some level of taxation. So we have to look at things as, should we use structures and how do we source the income and what mode it is. So we might use companies and trusts, etc., to help reduce your tax legally and sensibly and get it to a comparative rate. We also need to make sure that you've got a good debt management strategy because we only want to appropriately keep investment debt. We want to try and extinguish private debt because it's non-tax deductible, whereas investment debt is deductible. So we want to make sure that any of your debt reduction is going to private first and only afterwards into investment debt. And of course, if you're going to retain your offshore assets, we need to factor that into your planning and equation. Have a look at what the income streams would be, what your intentions are in the future of realisation, and how that may impact you for Australian tax purposes in the future. So there's quite a lot there that you do need to consider when you're looking to go to Australia. Now, the tax system is not pretty on the face of it. I've put the tax rates up there and you can see our top marginal tax rate in Australia for residents is 45% when your income is over 180,000 Australian dollars per person. Now, that's a high level by global standards, but it has been reducing. It used to be way back in the day 60 cents, it's now come down to 45. And you can see it's also moving up the threshold to 200,000 in about 2024. So they are trying to reduce the personal tax rate significantly in Australia to make it more globally competitive and fairer. In fact, you can see they're taking out the 37 and the 32.5% tax bracket and moving to a flat 30% from incomes of 45 to 200 from July 24 onwards. That's a massive shift of thinking in Australia and a very welcome one for everyone in Australia that's on salary. The key though is that might be the tax rate, but what is taxable? Now in Australia, you can deduct off any income you receive any cost at all necessarily incurred in producing that income. So they will allow you to deduct anything whatsoever. If it's work, you can claim uniforms. If it's investment, you can claim interest. Any cost incurred that's helping you generate that income can reduce it so that the tax rate applied is on the reduced amount, not the gross. And that's very important. A lot of countries do tax gross. In Australia, it's always net income that's taxed. We've also got sources that are tax advantage, and you want to really get a good feel of those and have them foremost in your mind when you're looking at being in Australia for the long haul. They include things like capital gains. in Australia, we do pay capital gains tax, but once you've owned those assets more than 12 months, half of any gain is completely tax-free. Now, what that means is it effectively reduces your tax rate from the 45% on the whole amount to effectively 23.5% on the half. So you've got the halving of that rate, 22.5%, I should say, rather than 45. So that's a big reduction. So you want to be encouraged to make capital gains in Australia through property, shares, etc., anything that you can sell for a profit later. In addition, we have a very fair system with our corporation dividends. They have a system called franking credits, wherein the tax paid by the company flows through the system to the eventual recipient as a credit against their eventual tax. Now, the Australian corporate rate for large corporates is 30 cents on the dollar. So what that effectively means is that if you receive the dividend, you don't have the company paying 30 and then you paying another 45 on the net difference. You pay only the extra between 30, the corporate rate, and your personal marginal rate, which, for example, even if you were on the top rate, would be 45. So you wouldn't have to pay a whole 45. You'd pay 45 minus the 30 cents credit. You'd pay net 15 on the dividend. So that's a very big advantage that you want to exploit later if you can, and certainly encourages you to look at Australian dividends as opposed to offshore corporations. But, again, you would weigh all that up on the merit of the investment and the strength of the investment. But if it came to a bit of equal, you couldn't make a difference between an offshore company and an Australian-based company, the franking credit would greatly work in your favour to make the Australian company a bit more advantageous and worthy of consideration. If you buy property in Australia, you get some depreciation allowances. And importantly, these depreciation allowances are also available on offshore property. So if you have got a property in Hong Kong that was built anytime after 1985, even when you move to Australia, you will be entitled to some depreciation allowance on that original construction cost. So we need to get it. It works out approximately 2.5% of the construction cost. So that's a 40-year write-off. And it ends up meaning almost a quarter of most rents come to you effectively tax-free. That's a big advantage when you do have those higher tax rates that you're getting used to. Superannuation is also very tax advantaged. Once you're in pension mode, your income in the super fund is completely tax-free income and capital gains. While you're in accrual mode for your superannuation fund, there's a concessional rate of 15%, which is also reduced down to 10% for capital gains. So that's certainly worth considering if you can get some funds into superannuation, whether it be rollover or contribution. But there are significant caps on those, so you can't just make an unlimited contribution to super. They've got currently a cap of $100,000 per annum, but can be done in a 3-year block per person. So you can move some money into that if you know you're moving to Australia in the near future, particularly if you're close to retirement age of thereabouts 60 years old. And of course, one of the most important things about Australia is there is no inheritance tax. Now that can be a significant advantage if you come from countries like US, UK. You really want to consider that as a big plus. And it certainly is a compensatory factor for the higher personal income tax rates. So that's a quick rundown on tax advantages, through the Australian tax system that you seriously want to consider and have awareness of. If you have a business or offshore investment, I just want to give you a couple of points there to consider as well. And first of all, with a business, the most important thing is it must have a genuine operation. Now, if it does so, then you'll only ever be taxed on extraction. So if you've got a business with staff, office, operations, you can make as much money as possible and they will not be taxed in Australia unless you take them out as a dividend, etc. But if it's not a genuine business, if it's purely just a shell company receiving investment income or holding assets, then that's not going to qualify, and it's likely that will be taxed at receival in the company. So each year, whether you distribute or not, you are likely to be taxed in Australia. There is look-through provisions that you must be aware of. In regards to whatever you do take out, anything that is in any form of income, director's fees, salary, bonus, dividend, that will be taxed in Australia, but you may not get any tax advantage on that. So there will be no imputation credit or credit for foreign tax paid if you don't do it right. So you have to be very, very careful how that's done, and we need to manage that. It's also essential that you get a very good valuation on your business from your accountant in the country of source, to put that cost base in place. Again, it's only the future increase on that cost base that would potentially be subject to tax in Australia. Now, you need a high valuation to obviously minimize that future tax, and a letter from a qualified accountant doing your accounts with a PE or something along those lines would be sufficient for that. And the higher, the better. You want to certainly have a good year. It's also essential that you distribute any retained earnings in the company prior to your change of residence. The reason being is if you do it prior, it's likely not to be subject to any tax in Australia, because Australia only taxes income received after the day of relocation. So if you pay it prior to arrival, it won't be subject to tax. The problem is a lot of people forget that and pay a dividend innocently, or a bonus or some sort of earnings. They paid a month, 2 months, a year later, and all of a sudden it's fully taxable in Australia, even though you could have distributed to yourself earlier without tax. So you certainly want to go through any balance sheet, clear up any bonuses, incentives, past salary, and put them on the books. Now, importantly, you don't have to pay them to yourself at that time, but what you do need to do is log them on the books and ensure that it's clearly shown that you have been entitled to and received that benefit, and it has moved from due and payable to loan account. If it goes to loan account, later on when you draw it down, it will not be subject to tax. So you want to have that very clearly on the balance sheet of the offshore company. One of the other things that a lot of people forget is bank debt reduction is not tax deductible in Australia. And this is particularly true for properties. A lot of people have their overseas properties with loans, and even though the loan might be a small amount in relation to the value of the company, it's got a very high debt reduction portion, so principal repayment portion. In doing that, a lot of people think that when they pay the bank and the cash flow is gone, that would not be income for the sake of tax purposes. That is not correct. If your repayment is $2,000, of which only $200 is interest, only the $200 is tax deductible, that $1,800 would remain as taxable income. And if you can imagine potentially a 45% tax, you'd be up for about $900 tax. But the worst thing is you've already given that money to the bank, and therefore you don't have the cash flow to cover the $900. Now you need to factor that into your equation and make sure that you're balancing the books and not putting yourself in an adverse predicament. And the other thing is that if you have businesses, property or whatever, consider moving that into an Australian trust or a company prior to your relocation or soon after, in order to get the tax flexibility that a company or a trust would do. Companies, for instance, have a lower flat tax rate. Trusts have the flexibility of being able to distribute to anyone or a corporate beneficiary and get that tax rate. That can be a lot more advantageous for you overall. However, you do need to consider what would be the local tax implications in your country of departure. Is there transfer costs? Is it easy, legally able to be done, etc.? It's not as simple as just saying, let's do it. We'd have to check with your local accountant, review the cash impact and cost of the transaction, and decide if it has merit. Some of the traps that you need to look at when moving to Australia to keep in the good side of the tax system are very, very important. First one is don't try to not declare anything. Now, we hear all sorts of stories about, oh, I'll just sneak it in, etc. You cannot do that in the modern world. Like I say, there's tax IDs on every bank account. You've got cameras at ATM machines. The computer generation is going to destroy hidden tax situations. So you must declare things. You should never feel worried to declare, especially when you consider that past profits are not subject to tax, only future profits. You cannot fail to declare. The penalties in Australia for not declaring are extremely high, and you could end up giving the entire profit away in tax and penalties, so there is no advantage to do so. Better to declare, better to work it out. And of course, planning is the best tool around everything. You don't need to worry about declaring if you knew what the consequences were, and we had already planned to minimize the tax impact on that legally and fairly. So you must plan everything that you do in regards to Australian tax. You cannot sell any assets within 12 months wherever possible. And the reason being very simply, if you sell within 12 months, the whole gain is fully taxable. If you sell 12 months and a day, only half the gain is subject to tax. So you really want to always put that in your memory banks and make sure that you don't buy and sell assets within 12 months unless you absolutely have to. If you can wait that extra couple of days, extra couple of months, it is so worthwhile with a significant saving with half being tax-free. You also want to make sure that you've got assets wherever possible in the right name. If you put them in the wrong name, it can have adverse tax implications that are very unwelcome. For example, if you have interest-bearing accounts and one of your family members is a very high salary income person, you don't want those accounts in that person's name, because even a little bit of interest on top of their other salary and income is going to mean that they're paying 45 cents in the dollar tax on that. Whereas if that was in the partner's name that was not working, they could earn $20,000 tax-free and there'd be no tax. So you want to make sure that you're considering whose name everything is in and what would be the implications. That's another reason to consider using structures where you've got the flexibility to move it around to suit. You also got to be very careful, as I mentioned, for deferring income that is due, if it is. So if you've got any amount due to you prior to your arrival, please get it payable to you or on the books before you move to Australia. If you just delay it, all of a sudden something that would not normally be taxable becomes very taxable, potentially at that 45 plus Medicare rate. So make sure you do that. And of course, don't do things just for tax. Usually that will make you put it towards a bad decision. And furthermore, the tax office has the power to say that if you only did it to save tax, they can bypass it and treat it as if that transaction didn't occur and tax you as normal anyways. So taxation is a consequence. It shouldn't be the dominant. You need to consider it, rationalize it, but don't make decisions based on taxation, because you could end up going down the wrong path. And one of the other big mistakes people make is delaying the acquisition, particularly of their future home. If you are looking to buy in Australia, it has traditionally been a stable growth market. You want to consider buying your home as early as possible so you get what you want, you know how much you need to pay it off, and you hopefully buy it at today's value rather than tomorrow's. At the same time, it can bring you some nice tax advantages, which I'll show you just in a minute. So these are the real things that most people do wrong. Hopefully, if you bear those in mind, you're going to have a much tax-friendlier arrival and life in Australia in the future. When we look at property in Australia, it's always been a very, very popular asset choice for many Australians. And the reason being is we can use property to increase our wealth and also reduce our tax. Now, here's a very simple example of $600,000. And what I'm going to do is to show you how it would work for tax purposes, annually and also long term. Now, what would happen here is if we bought that property, we'd probably be putting down a 30% deposit of 180 grand. And the purchase cost, in this case, I'm using 4%. Now, the higher the purchase price, the higher that purchase cost would be, because stamp duty in each state escalates. And importantly here, I have excluded any foreign buyer's fees. You really need to consider those if you don't already have your permanent residency visa. So, that now can be 8 or 7% in most states. So if you're going to buy prior to your visa being granted, then you might find that there's an additional cost. In New South Wales, even if you have your permanent residency visa, they will still charge you the foreign buyer's fee of 8%, if you haven't lived in Australia for more than half of the year. So you need to factor that in as well if it's applicable. But I'm assuming for the sake of argument tonight that most of you would probably already have your permanent residency or would be in process with it. But it certainly is advantageous with a 7 or 8% cost to have your PR sooner than later. So hopefully you're either got or well advanced on it. If we buy that property, we're putting in $204,000 to buy a $600,000 property. So that's called leveraging. Now the ownership cost would be rent income minus any ownership costs. So in this case, the rent would be approximately $24,000. Ownership costs on average are about 2% or $12,000. And of course, we borrowed 70%, and I'm just using 4.5% as a guide there, which would be about $19,000. So even with the 30% deposit, we've still got a shortfall each year on this property of approximately $6,900. Now, that carries forward into the future to ensure we're not paying tax annually, and it will also carry forward in the future to offset our future Australian taxable income. But it gets increased by any tax incentives of depreciation, etc., on that property. So if this was a brand new property, we'd be receiving around about $11,000 worth of depreciation incentives, depending on what it was, house, apartment, etc. And what that means is, even though we've got a cash outlay of $6,900, we'd have a tax loss of $17,900 to carry forward into the future. And you can see there, after 5 years, that tax loss would now be $90,000. So if you know you're going to Australia in a few years' time, that $90,000 carry forward loss is substantial to reduce your future Australian income, which would include salary, investment, or business income. So what that means is our first $90,000 of income would not be subject to tax because we would have this to offset it. Now that's likely to save you about 30 cents on the dollar. So $90,000 would save you about $27,000 to $30,000. Now that's almost as much as it's cost you to keep the property over the whole 5 years. So you get a $30,000 tax saving in the future. You've had a $34,000 ownership cost over 5 years. You're basically holding that property for very little, if nothing, after tax. Now, the key thing here is that we don't want to lose money just for the sake of a tax benefit. We want to be making money on the investment. Now, you can see if I look at it from a pragmatic point of view, I need to recover my $6,900 cash shortfall each and every year just to break even on the property. Now, that equates out to a required growth rate of 1.15% on the property. So one would have to assume there is a high likelihood that we could achieve 1% or more growth. The 1% growth covers my holding cost, which will also get back as a tax benefit, and everything above that is profit for me. Now you can see up the top there, the growth component at 5% assumed growth would move the property value from 600 to 765. So I'm going to have $165,000 of potential gain for a $34,000 holding cost. So that's very, very attractive. At the same time, I'm improving my tax position, but where it gets even more appealing is I've bought that house potentially that I could live in at today's price of 600, whereas if I did not do this, I've got to pay tomorrow's price of 765, and I won't have any tax relief built up. So I've got 165,000 benefit in value. I've got 90,000 benefit in accrued tax benefits. That's putting me in a really good stead to have a future wonderful life and tax advantage life in Australia. So it's very, very compelling to start your property ownership as early as possible before you move down, if you can. In terms of retirement in Australia, particularly for migrants, it's going to become more and more popular, I feel, particularly with all the madness going on in the world. And what I'm showing you here is how you could easily structure your affairs to not pay much tax at all if you wanted to move down to Australia with reasonable wealth and live a comfortable life in retirement. Now, in this case, I'm assuming that you've got 2 million Australian dollars after paying off your future family residence. So you've bought your home and you've got $2 million investable cash. Now, some people have a lot more, some people have a lot less. We've got great tax modeling in this, and this is the simplified version. But for your personal circumstances, we'll punch in all the numbers and work out what's best for you and most comfortable for you. Now, in this case, if you look at the top with no tax paying, many people would just stick that money in the bank and try and live on it for the rest of their life. But interest rates these days are so low. I'm generously assuming 1.5% in this case. That would be $30,000. Now, if this was a couple, the tax on $30,000, if that was your only income, would be zero. You can earn $20,000 tax-free per person. So we could have earned another $10,000 and paid no tax. But $30,000 is great that we pay no tax, but that's not enough to live on. Now, we don't have a cost of living in our house because we've owned that and paid it out, but that's all we've got left to live our life. What that would likely mean is that with that not being enough, I'd have to start eroding through my $2 million each and every year. and it would gradually whittle down. Hopefully it lasts me a lifetime, maybe not, that depends on your spending. Alternatively, if we just were a little bit smarter with the allocation of that money, instead of leaving it in the bank, we looked at some things like putting a bit in a super, which is tax advantage, and in retirement mode, the pension is tax-free. Property, which comes with the depreciation allowances, shares which come with the franking credit advantage, and some syndicates which boost our return up well above average with safety and reliability, and leaving a little bit in cash, just as a slush fund. You can see what that does is, instead of a $30,000 income, the combination from all sources is $106,000. So we're $70,000 more than if we just plonked it in cash. And that's from the various returns from the different things. The pension bringing out at 5%, property 2.5% net rent, share dividends about 5 on average for Australian companies, syndicates pay 12, and cash still at 1.5. Now you can see, importantly, even though we received $106,000 of cash income, if you look in the taxable income column, we only have to pay tax on $76,000. And that's because the pension is not subject to tax, the property has the depreciation, and then we do have to gross up for the dividend imputation credit, but the combination is $76,000 payable tax income, of which the tax thereon is $9,000. Now, before we have to give $9,000 to the tax office, we take off the tax credit from the Australian share imputation of $8,000. So what that means is our income tax payable is only $1,200. So we've got $106,000 of cash flow, $1,200 of tax. That means we've got $105,000 of taxable income after tax. That's not a bad scenario. That's more than enough to probably cover your holidays, your living, your enjoyment. But importantly, have a look at that effective tax rate, 1.15. That's pretty damn good. So even though we have the tax rates of 30%, we've managed just with a little bit of sensible planning to achieve an effective tax rate of just 1%. That's the importance of some good thought and good planning. In addition, we've also got some capital gain potential on those investments that have gains, like shares and property. But importantly, as long as we don't sell those within 12 months, they would be half tax-free. So that $49,000, half of it would be tax-free. So the tax potential is about 30 cents of the dollars on 40 grand, on 24,000. So that's only about $8,000 tax. So we'd have 40 grand after tax capital gain, 105 after tax income. That's 140,000 improvement in your position every year, less whatever you spend. Hopefully you've got a little bit of surplus or you've got a comfortable lifestyle. So this is just a snapshot. Obviously your circumstances will be different. Everybody's is, everyone's risk appetite, everyone's willingness to do things is different. But we've got really good modeling that can help you look at it from your perspective, factor in your assets, and let you know exactly what you'll be walking into. Now, this is particularly in retirement very good. Obviously, if you had a salary, your tax would be a lot higher because that salary would be sitting in there. But again, we can work it out, get it to an acceptable level based on sensible planning and strategy that's legal, sensible, and profitable. That's very, very important. Finishing off, what are the secrets of success if you are considering moving to Australia? Well, the tax isn't that bad if you give it thought. And the most important is start building up your property portfolio with sensible debt while you can. In the good old days, debt was readily available for everybody, but it's a lot harder to get a loan today than ever before. And what that means is not that you can't get a loan, but you shouldn't go looking for a property until you've had your loan assessed and been told what you can get. There's no guarantee that you'll get a loan living overseas anymore because they've tightened the rules. So make sure you get what's called a pre-approval. Our team of Specialist Mortgage will help you with that. We're the experts. We'd love to get you sorted. Get those losses building up prior to arrival because they're extremely valuable in keeping your tax at a sensible level. Ensure that you avoid private debt wherever you can. Don't pay it off until you get to Australia. Accrue, invest, liquidate, reduce debt on your private home at that time. That's the best place. Consider getting those Australian shares now for income and the future franking credit. The franking credit doesn't apply when you're living overseas, and only because the income and the capital gains from those Australian shares are not taxable if you're living overseas. But you want to get familiar with the companies and start getting some of those higher yields in preparation for your arrival. And always consider and remember that capital growth is always going to be preferred over income because it's potentially half tax-free. So you want to think capital growth. You know, it's certainly a good, important element. A combination of all works. And of course, get your earnings in the right place, whether that be a family trust, a company, a superannuation fund, whatever the case is, think about it, make sure that it's there in the right place. We don't want extra income on a high salary income earner. That's not the good thing. So we need to look at these things in full light and make sure it's right. And critically, just make sure you plan in advance, review regularly. So every year that you get it closer to relocation, check, see how you go. And that's what our modelling will do. It'll let us set it now. How long do you think you're going to go? Let's check it every year that you're on track. And if you're going soon, you'll know exactly what you can achieve in a preferential tax environment to suit your circumstances. On that note, I hope that was informative. We've tried to give you as much information as possible, you know, in a general sense. We're definitely here to help you in a personal sense. Our modelling will just help you get great clarity. So if you want that assistance, come and talk to us. We'd love to help you. And on that note, thank you very much for your attendance. And I'll pass back to Julie.
Thank you. We've got a load more questions, so thanks to everybody that's been emailing them in or submitting them on Zoom. But please, if you've got any more questions, you can send them to myself at julie@smats.net, or alternatively smats@smats.net, or you're welcome to submit your inquiries to www.smats.net/inquiries. Other than that, thank you so much for taking the time to join us tonight. I hope you had a lovely evening. We'll be in contact soon.